Hi, everybody. This is Dan Sheridan and with Sheridan Risk Management. And I want to share some thoughts with you today about this topic, designing an options trade in a crash. What do you do right now as of uh, April 5th here? We're down about 17% or 1,000 points in the SPX, and it comes pretty quick. VIX is at the 45 level. Um, uh, as my Irish grandmother would say in times of trouble, or uh, this is someone who lived through the Depression, when I would throw pieces of toast a couple times in the garbage, she would take them out and wash them. Uh, uh, Dealt through very tough times raising a family, but she used to always tell me when there was something, you know, unsettling, which I apply to the market. This too will pass, right? Um, and so I'm just going to give you some thoughts. I have about 12 or 13 thoughts, just you know, some things I've learned over the years, and maybe some things that could help you next week as you're in this very volatile, tumultuous uh, time, and hopefully can help you get through it. And again, could last 6 months, could last another month. I mean, in terms of volatility in the market. And we'll look at a couple. We'll look at the COVID graph, uh, and that was a crash. But also you had something like 2022, the market was down 10 months or so. So let's talk about some of these principles. Uh, Define risk trades versus naked options. I think, you know, I think it should be all the time, but defined risk trades are wonderful because they're what they say they are. Going in what's your risk. The brokerage firm takes out usually defined risk trades. They can be debit or credit trades. And so you know exactly what your potential risk is. You know what your potential reward is. It takes some stress out. Naked options, uh, they're not like bad, don't do them. I don't teach them. I don't see any, do some very experienced people do them in certain situations? Yes, but I overall wouldn't. And one of the main problems is when you do naked options, your yield goes down because your capital goes up, unless you're in like a portfolio margin account. But even if you're in a portfolio margin account, when the market goes against you, the risk isn't just limited to price movement. People think, well, price movement. No. When the VIX, goes from 20 to 45, which is where it is now, 45, and less than a week and a half ago, VIX was 17. And and so that can cause a lot of problem, right? You're down a lot more than you thought you would. You say, well, price movement, I would have lost this amount, but now the volatility component comes in. And with naked options, Uncle Guido from the brokerage firm will say, hey, you better come up with more money immediately. So again, define risk trades versus naked options. The best risk management tool in the world, in my opinion, is size, right? Just like defined risk trades are great, size is great because you can limit it. How much capital do you want at risk? Do you want to do one contract, two contracts? What, in a more volatile situation, uh, I'm using less size, right? In most instances, right? Not all, but most instances. And and so that's really important, right? You may not want to do 10 contracts, but maybe you do one. And again, one of the keys in a volatile market, uh, well, sizes uh, tool. I'm going ahead of myself. Let's go to the next thing. This thing called high implied volatility, or VIX is up, or the extrinsic value in the options that you look at go through the roof. They're high. Why? Because you're having bigger moves. The last couple of days we had 4 or 5% moves in the SPX. So volatility is very high. And let's talk about that for a second. First, let's look at a couple of big down periods that we've had. And here, the first one you're going to look at is the COVID crash. And you could see very quiet, very low implied volatility. And then we go down 800 points very fast. That's one of the trademarks of a extremely volatile, heavy downside market. It's fast. You think about, we've shed 1,000 points in a very short period of time, with maybe a month and a half. And what did it take the market to go up 1,000 points? Over a year. I mean, much longer time. And that's what unhinges people. And so if you look here, as the market was going down 800 points in the COVID correction in 5 weeks, the VIX went from 20 to 80. And so, what do you do? And we're going to talk about different parts of the portfolio, but, a couple of things you don't know. And, when do you start, if your long-term portfolio, like, hey, I'm buying stocks or ETFs for little Susie's college fund, when do you buy them? And we're going to talk about this principle of scaling in a second. But the other thing is, when do there's this principle of selling volatility. We're supposed to sell volatility when it's high. No, you're not. I think you sell volatility when it's high, but when the market starts stabilizing. So, I wasn't looking at selling, people weren't looking at selling 80 volatility in the COVID correction. I think once it's stabilized, I'd rather sell 50 volatility when it doesn't look like the world is ending. And those are some principles. The other period that I want to talk about that lasted much longer, if you look at, let's go through this, 4 years. Let's look at 2022. So in 2022, and this goes from beginning of the year to October. I mean, we went down like, 1,400 points. That was slower. And one of the things there is we had a high VIX. VIX levels were probably, overall, 19 to 31, right? In a typical year when we're uptrending, the option volatilities might be, 11 or 12 to 21, right? Here, we're just and this could be the case this year, 19 to 31, it was higher. So that's a different type of trading than people are used to, isn't it? And so it can last a lot longer. COVID was more severe in terms of the amount of dollars in the SPX that you went down. 2022 was similar to COVID. It just took longer to do it, right? All right. Let's go back to the thing here. Probably one of the biggest challenges in a volatile market or a crash, liquidity. I would not I'd be very careful in stocks that don't trade a lot of options, because if there's ever a time you could pay 20, 30, 40, 50 cents, $50 more in a trade, it's during this period of time. And I've seen that in the last week. You have to be very patient. Even if I wanted to buy 10 or do 10 spreads or something, if it's a debit transaction, I'm going to watch the mid-range. There is no such thing as a mid-price, a mid-range. I'll watch that for a while, put it much lower, and then slowly build it up to see where the fair value, where they're trading this thing at. That'll give me an idea, because you could really pay up in these type of situations. And, when I was a market maker in the pits, I'm sure there's similar like that now. When things are very volatile, when the market's really moving, you can make your markets a bit wider. And so execution is just, I can't overemphasize how important it is to be very careful when you're getting in. And so staying with liquid vehicles, patience when executing orders. If it's a debit transaction, if I put my debit in a little bit below, let it come to you. It's once the market, what I've noticed the last week, once the market turns one way or the other, going up or going down, we can jump 50 points in minutes, right? So I'd rather, if I'm trying to get long, like buy a vertical debit spread, you'd rather it when the market's going down and you think, close to where you want to buy, get it where there's still pressure a little bit on the downside versus once it starts turning, it's harder. They raise those prices pretty quick. So risk of overpaying is something I'm concerned about. For people who are looking in the long portfolio or maybe the retirement part of the portfolio, maybe you buy stocks, maybe you buy ETFs, maybe you buy leaps, maybe you buy longer vertical debit spreads. Make a shopping list and use the principle of scaling, picking levels to buy. Have a plan. Don't go into next week without a plan. And we'll talk about that some more. Picking levels to buy, right? If I have $1,000 to put into a trade, start with $300, right? Because, could SPX go down another, couple hundred before we come back? Sure. So scaling, right? Range bound trades principle, if you're looking at things like uh, credit, vertical credit spreads, iron condors, butterflies, calendars, those type of trades, one of the principles is uh, principle I learned when I was in the trading pit, generally short delta, if you're a short Vega trade, that benefits if volatility goes down, you want to be a little bit short delta. If you're long Vega, you have a position on that benefits if volatility goes up, you want to be a little bit long delta because those are your two biggest risks, price and volatility. So you want them a little bit offsetting. But some principles with range bound trades, get a little more duration. Uh, uh, the farther you go out, you have less gamma. What does that mean? Your position deltas won't go against you as much, which is crucial. And again, same principle, you know, uh, but the general principle with range bound trades is, again, I don't want to sell high volatility. I want to sell high volatility once we get a little bit of stability, right? Next, trades that benefit Mark, if you have a move in either direction, think about this. If I'm covering it here, uh, what are trades? Should I put traders? What are trades that you absolutely would not do? You say, Dan, there's no way right now I would do an iron condor. How about the opposite? There's no way I would do an iron butterfly. Do the opposite. And, to just give you just a few things, one of the trades that has worked relatively well over the last month or more, a reverse iron condor called a Rick. And that is something that has, I've done it, but, some uh, communities, like specifically Options Omega, and my friends over there, Troy, Matt, and Rusty, I mean, that's been a very effective trade. And I like it even more than when I was in the trading pit. We did these ratio back spreads: buy two puts, sell one, buy two calls, sell one, buy three calls, sell two. And they work nice. But some of the some of the trades that we used for directional purposes, where you could benefit either way the market went. The two most popular trades in the trading pit were a reverse iron condor, excuse me, a reverse calendar, just the opposite of what you would think a calendar would be, and a ratio back spread. The both would benefit um, for a big move. When volatilities are more on the lower end or going up, starting to go up, a ratio back spread work well. Not that it can't work in a high vol environment, but when the volatilities are higher, a reverse calendar. The problem is the brokerage firms, unless you're in a portfolio margin account, destroy as far as how much capital to put up on these trades, even though they benefit in a move either way. So something like a reverse iron condor, a reverse iron butterfly, these type of trades work really well. Um, and when I say something works real well, I'm not saying a newbie go in and obviously you have to understand the strategy, but it has low volatility risk and it can make money in either direction. And you don't need that big of a move, right? Risk of buying options. Again, right now, because there's a lot of extrinsic value in these options, a 1 month option that you normally would buy that's $4 might be $15 or 20 right now. So you're going to the grocery store and you're buying the $3 watermelon for 25 bucks, right? You better really want that thing. So if you're going to do directional, right, trade, sell an option against it. Do a wide debit vertical spread, or do a, directional butterfly or calendar, but use a spread. Assignment potential problems. Don't let, if you have options get in the money, deal with it before you get to expiration, because then you got to get out of it in a liquid market or you get a lot of problems. So don't leave your short options or long options necessarily till expiration, especially as they get in the money and the extrinsic value disappears and you can have a lot of problems. If you're beginners, I like a lot of these, the 11 ETF sectors in the SPX. A lot of them are under, $100, $120. And so you can get involved in those. You can do strategies like poor man covered rights called long diagonals. We do those, something to do. Again, we already talked about trades you absolutely would not do. Think of the opposite. And then last, again, just hammering this home, have a plan or thesis or don't trade. It'll reduce stress levels. But again, when you're going in a volatile situation, I think I was never in the military. I'm very appreciative of everyone who served. But how did they get these 18 or 19-year-old kids to go in the military and then in battle? They know what to do. They've been trained well, right? They know what they're going to do, right? And have a plan or don't just go in the emotions of the market. It's very unnerving. So I hope some of these thoughts will be a benefit to you next week, just and help you dealing with this thing. And the other thing, again, I just want one more thing on this. Picking the bottom or something like that. I just think that scaling is a much less stressful way to do it. And if you're interested in trading with us and navigating through the next couple months, come in. We're at Sheridan Risk Management, and you can come in there for a month, and it's we can give you $97. And we have a couple hours live a day, and they're taped where we're going over stuff, live trades, and we have a Discord channel, so you have some of the veterans in the community and see what they're doing. But we'll navigate through the next couple months together, and I think that could be a big help to you. So come in, join us for a month, and best of luck to you next week with the trading. Thank you. This is Dan Sheridan from Sheridan Risk Management. Thanks.